You've seen the headlines, right? A massive company is on the brink of collapse, and suddenly everyone is shouting one word: bailout. It's a word that gets people really fired up. But what does it actually mean? Well, today we're going to peel back the layers and really get into the anatomy of a financial bailout, what it is, why it happens, and what the real cost is. And this question right here is the one that really hits home for all of us. I mean, why should our tax dollars go to rescue a company that, let's be honest, probably made some pretty risky bets? It's a fair question, and the answer is usually tied up in one very powerful and pretty controversial idea. Yep, there it is. Too big to fail. You've all heard it. The basic thinking goes like this. Some companies are so woven into the fabric of our economy, we're talking giant banks, automakers, you name it, that letting them just collapse would be like yanking a critical support beam out of a skyscraper. The whole thing could come crashing down. So to stop that from happening, the government steps in. Okay, so the government decides it has to step in, but what does that actually look like? This is where we have to be really clear, because the word bailout gets thrown around all the time, and honestly, it's often misunderstood. Okay, I want you to focus on that last part. No prior legal entitlement. This is the absolute key. A bailout is not like an insurance claim that you're owed. This is an emergency, last-ditch decision made when a crisis is already exploding. There's no contract, no pre-existing agreement. It's a choice made under immense pressure. And this is the perfect way to see that difference. You know how the money in your bank account is protected by the FDIC? That's not a bailout. Your bank pays regular premiums for that insurance. It's a planned safety net. A bailout, on the other hand, well, that's like the fire department showing up to a building that never paid for fire protection. Because if that one building goes up in flames, it's going to take the entire city block with it. And you know, it's wild to see how this all changed over time. 100 or so years ago, this wasn't even the government's job. During the Panic of 1907, it was one incredibly wealthy banker, J.P. Morgan, who basically strong-armed a solution and saved the system. But that crisis is what led to the creation of the Federal Reserve. The responsibility shifted from a private citizen to the state. Fast forward to 2008, and the government was really the only player big enough to fight that fire. So, we've talked about what happens with companies, but what if the problem is even bigger? What happens when it's not just a corporation, but an entire country that's about to go bankrupt? Who plays the role of the ultimate rescuer on a global scale? That's where the International Monetary Fund, the IMF, comes in. You can basically think of the IMF as the world's financial 911. When a country's economy goes into a total freefall, the IMF can step in with massive loans, trying to stop the crisis from spreading and becoming a global economic disaster. And the sheer size of these country-level bailouts is just staggering. Take Indonesia in 1997. The rescue package, led by the IMF, was worth nearly 20% of the country's entire economic output for the year. Just try to imagine that. It's like being given a check for 1/5 of your entire annual salary, all at once just to stay afloat. It's immense. And as you can see here, Indonesia was not a one-off thing. The 90s were full of these massive bailouts. Mexico, Thailand, South Korea. The IMF was working overtime, deploying huge amounts of capital to stop these regional crises from spiraling into a full-blown global meltdown. All right, so since a bailout is obviously a last resort, the billion-dollar question is, can we see these things coming? Let's talk about the red flags regulators watch for. And, just as important, the unexpected consequences that pop up even when a rescue works. Seriously, can you actually predict a financial earthquake? Well, it's not a perfect science, not by a long shot. But there are definitely tremors. There are signals in the market that smart people watch very, very closely. Signals that can warn that something big and bad is on the horizon. So one of the biggest signals is something called a credit default swap, or a CDS. Now, it sounds super complicated, but the idea is actually pretty simple. A CDS is basically an insurance policy on a company's debt. If you own their bonds and you're getting nervous they might go bust, you can buy a CDS to protect your investment. The price of that insurance is called the spread. And when that spread starts to skyrocket, that's a massive red flag. It means the market is betting that the company is in deep, deep trouble. It's the market's way of screaming, "Danger!" So let's say the warnings get missed and a crisis hits. A bailout is announced. Phew, right? Everyone can relax. The company is saved. Well, not so fast. It's way more complicated than that. Sometimes the rescue itself can create a whole new batch of problems. This is one of my favorite concepts in all of finance. It's called the stigma paradox, and it's totally counterintuitive. So imagine you run a pretty solid company, but you're just having a rough patch. A little government help would be great. But if you take it, everyone might think you're on life support. Your customers and partners might get scared and run away, so you don't ask for help. This means only the companies that are truly at death's door will take the money, which just reinforces the market's belief that accepting a bailout is a death sentence. It's a real catch-22. So how do you solve a paradox like that? Well, the solution is just as weird as the problem. You make everybody take the money. This is exactly what happened in 2008 with the TARP program. The Treasury Secretary famously brought the CEOs of the 9 biggest banks into a room and basically said, "Congratulations, you're all taking this bailout money, whether you need it or not." It was a controversial move, for sure, but it was also a clever way to give cover to the banks that were genuinely about to fail. So we've established that a bailout can prevent a total collapse, but it's definitely not a free lunch. There is a price to be paid, both in the risk taxpayers have to take on and in the very strict strings that come attached to that rescue money. Let's talk about the true price of stability. This quote gets at the hidden risk. In Wall Street terms, a bailout is like the government issuing a put option. But let's make that simple. It basically means the government is selling an insurance policy to the entire market. They're saying, look, if this company completely fails, don't worry, we promise to buy its worthless assets from you so you don't lose everything. And who pays the claim if that disaster happens? We do, the taxpayer. All that risk gets moved onto the public's balance sheet. And that brings us to maybe the biggest misconception of all, that this bailout money is just a free-for-all, a blank check handed over with no questions asked. The reality could not be more different. Far from being a free lunch, this money comes with what is basically a financial straitjacket. There are strict caps on what executives can be paid. Those huge golden parachute severance packages, banned. Paying dividends to shareholders or buying back stock, frozen. The message from the government is crystal clear. This money is for survival, not for rewarding the people who got the company into trouble in the first place. So in the end, where does this leave us? Bailouts are messy. They're an imperfect, often infuriating solution to a really terrifying problem. They force a choice between 2 bad options: let a company fail and risk economic chaos, or step in and create a whole other set of issues. And maybe that's the real takeaway here. The ultimate goal shouldn't be to get better at rescuing failing companies. It should be to build a stronger, more resilient financial system that doesn't need rescuing in the first place.